This is MarcoVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MarcoVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Darius back on the show. Now, joining us again in the post-game segment is Nick Galarnik. Now, let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MarcoVoices.com. Just go to our homepage, MarcoVoices.com, and click on the red button over Darius's picture saying looking for the downloads. Now, Eric, let's cover crude oil starting with the EIA inventory.
Crude oil built 1.2 million barrels. Cushing, Oklahoma drawing down 2 million barrels. Gasoline building 1.2 million barrels. Distillates drawing down 2.5 million barrels. That's a net petroleum drawdown of 100,000 barrels. U.S. production bouncing back to 13 million barrels. Remember, it was at 13.3. Then we had a massive 1 million barrel drawdown last week because of inclement weather in North Dakota, making it too cold to pump oil in the Bakken. They're getting a lot of that idled production back online this week, and that's why we're seeing the bounce. The question, as I mentioned last week, is how long it will take us to get all the way back up to 13.3 million barrels. We saw a nice bounce this week, getting most of the way there. Hopefully the rest comes in the next few weeks. Overall, the market continues to firm up. We've sustained above the 55-day moving average for over a week now, so that's definitely a bullish sign. I wouldn't go so far as to say that we have a face-ripping rally or anything, but it does look like a trend higher is finally in place. Time spreads are confirming that, and I personally think it's a much bigger question mark than most market participants seem to have considered as to just how far this situation with the Houthis in the Red Sea could go.
I've been for several weeks, Eric, looking for a breakout above that December high to really show that there's a new accumulation cycle happening. It didn't make lower lows. It created a base, starting a pattern of breaking out. To me, this entire area around the 50-day moving average, which lies in that $74, $75 area, is going to be a real inflection point. If we see this dip get bought and the support lines hold in that area, and turn back up, I see every opportunity for crude oil to get into the mid-80s. And now I know we had Anas on the show saying that we could stay in these lower boundaries for the entire year. And while I see that as a big picture view, I still don't see anything out of character if crude oil went up even temporarily up into the 90s before mean reverting back down to the bottom end of the ranges. So we'll be looking to see whether this wave of the cycle has more upside on crude oil. Okay, moving on to equities. I want to get Nick involved in this conversation. Now, Nick, the S&P 500 had a huge ripple all week, and then the FOMC turned it. What levels are you watching, and what do you make of this market?
Yeah, Patrick. So right now, the spot price of SPX is approximately $48.65. We have a call wall above at $49.50 and a put wall below at $48.00, which is also heavy support. The implied move for the February 16th monthly OPEX is plus minus 100 points. Therefore, the upper implied move is 49.65 and the lower implied move is 47.65. Key resistance is above right now at 4,900. All that said, I'm inclined to think that we see a move lower somewhere around the 46.50 mark on SPX. However, with Meta, Apple, and Amazon reporting tonight, it's still to be determined if we're going to see that move lower or not. Also, Powell spoke yesterday at the FOMC meeting. He was not nearly as dovish as he was in the prior meeting and has kind of pushed out the possibility of rate cuts. So the market kind of got spooked by that. I'm waiting to see pretty much if we break that key level of 4,800, which is also support. And I'm kind of in this holding pattern right now.
I agree with almost everything you said. The key here for me is 4,800. One day does not make a new trend. This certainly was a breakdown candle, but it was a breakdown on the FOMC really from a very overbought state. The market really would have needed a very dovish statement in order to just keep plugging away. So we have some sort of a correction underway, but like you were referencing, that one-day correction could immediately reverse if we have bullish gaps on earnings on those Mag 7 stocks that are reporting. To me, the 4,800 level you referenced is the pivot. If we have any correction, even if it drops another 50 points, it's nicely bought on dip and turns back up, we could be punching 5,000. To me, when we break below 4,800, that signifies that there's a short-term top put in, but then there's some sort of bigger, more prolonged correction, usually the ones that last a month or more and usually are of the 5+% variety, might get underway. And that doesn't necessarily mean that the big kahuna is here and that there's some big recessionary bear market drop about to happen. Often we need to see topping formations, and we could spend months just sorting out things along these highs. The primary trend is still bullish, and Darius Dale was referencing that this momentum still continue, but the rally getting checked here and us going through some sort of a correction, maybe as deep as that 4,600 level you were referencing, is 100% on the table. Moving on, Nick, I wanted to get your levels on the NASDAQ.
So right now, the Qs have a spot price of approximately 420. There's a call wall above at 430, also all-time highs, and a put wall right where we are right now at 420. The implied move for the February 16th monthly OPEX is plus minus 12 points. Therefore, the upper implied move is 432, which would be new all-time highs, and the lower implied move is 408. Right now, key resistance is above at 430, all-time highs, and key support is below at 410, which are previous all-time highs. Again, I'm inclined to think that we see a pullback in broad markets, but again, that's contingent upon Meta, Apple, and Amazon reporting tonight. We'll see how they do and go from there.
The big thing for me is whether or not we finally see some sort of sector rotation. If those Mag 7s in any way disappoint and start moving down, it doesn't need to drive a liquidity event, but it may finally end the cycle where the Mag 7 were the true generals and leadership, and maybe we might see some of the beaten down sectors, particularly yield sensitive areas, start getting some of that rotation. And I think before I jump to the conclusion that that's underway, I think we just need to see what happens on these earnings. But if we really do see those Mag 7s turn, that's definitely a thesis that I want to kind of see whether it starts to develop. Anyway, moving on to the volatility index, Nick, the VIX remains actually quite low. I mean, it was not exactly a crazy day yesterday. I mean, it was a correction, but it certainly didn't drive these spikes up into the high teens on the volatility index that one would have thought would start to accompany it when market participants are getting nervous. We're still in a very low vol range. And to me, I can't help but to think that being a long vol here going into February is a reasonable way to be positioned. Particularly, I was going to highlight, while I don't have the chart here on the longer term, we still have like 3-month and 6-month volatility premiums still in the mid to high teens, and 1-year volatility that is overlapping the elections is still in the teens as well. And so overall, the entire vol structure is very low, and I just think that the market has so much room to be more volatile than the current conditions are suggesting. What's your take on the VIX here then?
Yeah, so with the VIX right now at around a level of 14, that denotes approximately 0.8% movements top to bottom intraday on SPX. Volatility has been very subdued, primarily because of these buy right and covered call selling ETFs, which are selling premium in both directions as we move around. So right now, with that key level at 4,800 on SPX, that's the key gamma flip area. If we get below that somehow today or tomorrow, perhaps, we could see a wave of selling that surprises a lot of market participants and pushes us to the downside in a very rapid fashion. I don't really expect that to happen, but again, these are the kind of events that happen out of left field that no one really expects and no one's really prepared for. I do agree that 3 and 6 month volatility is very, very cheap, and the market's essentially pricing out any exogenous risk events that will likely transpire at some point in time. Again, what those will be remains to be seen. But moving on to page 7, we have the US dollar index. What are your thoughts here?
Well, we're consolidating and hovering just over 103. It's very curious to my mind as to what's driving this tape action. The reaction to Jay Powell saying effectively that a March rate cut was not something that anyone should expect or not to plan on it. Really, that was a fairly muted reaction in the dollar compared to what I was expecting from a statement of that magnitude. So I don't know what's holding us up at 103 spot something, why we haven't come down from this level, what's holding us above 103, and why it didn't move higher above that level on Jay Powell's comments today. So I'm a little bit baffled by this tape action in the dollar.
Eric, this level on the dollar index continues to be incredibly important to me. Not only have we fully retraced that December Powell pivot, but we are consolidating in this range. We obviously have an ECB that has now also given dovish indications. And I think that in order for the dollar to be weak and head back down to the 100 level, I think it's a competition between which central bank is going to be more dovish over the next coming period. If we see any of the data cracking in the economic numbers being released in the weeks and months to come, that could arguably spur a dollar reaction. To me, breakout above this 104 to 104.5 while sustaining above the 50-day moving average would actually feed the risk-off cycle and drive some further corrections. So we're at a pretty critical pivot, and we'll see whether this 104 acts as resistance as we move forward.
Now, on page 8, Eric, you've created this long-term chart on gold. I'm very interested to hear your thoughts on this.
I've rolled my chart over to the April delivery contract on my continuous futures chart, and the contract roll alone accounted for a $20 bump higher in price this week. But the market was firming up even before the effects of the contract roll. And while the knee-jerk reaction lower to Powell on Wednesday, when he made his statements about telling the market not to expect a March rate cut, the move lower in gold was, needless to say, predictable, but frankly, it was muted compared to what I would expect given the magnitude of that statement, and it started retracing within minutes after it happened. It had retraced 50% of the distance that it moved before the close on Wednesday. So it seems like the market is not going to freak out as much as I would have thought about no rate cut from the Fed in March. We'll see how this happens if the rate cut really doesn't happen, how gold does at that point. Moving out to the longer-term perspective on gold, I've included a weekly gold chart in this week's slide deck to give our listeners a better sense of the big picture move that we've all been waiting for in this gold market. So the green line shows the level of the 2011 top at $1,922, that blow-off top that we had back in 2011. That's where the cup formation in this cup and handle pattern begins in the summer of 2011. The handle portion began with the COVID top starting in the spring of 2020, and that's when the key resistance level of 2089er was established. The upper horizontal magenta line is key resistance at 2089, while the lower magenta horizontal is the weekly closing high until very recently. So the market has moved above that level, above 2028, which was the closing high until very recently, and it's sustained above that for the last few weeks now. So it looks like we're getting even closer to a breakout above that key resistance at 2028. If we look at the overall target for this cup and handle formation, I get 2724. That's $2,724 is the upside target, which is measured basically as the size of the cup vertically added to the top magenta line. And you multiply that by 61%, which is the efficiency ratio of this particular measurement, and you end up getting 2724 as an upside target for gold. The signal that would indicate that that is on the table would be a sustained move if we got above the level of 2089 and stayed there for at least a week or two on the continuous futures chart. So we're getting closer and closer to it. If we get that, don't be surprised if you see a lot of volatility in the gold market, because it would be a buy signal to suggest an upside target of 2724.
Now, Eric, I continue to be big picture bullish gold. And so your chart, I totally get your levels and what you're looking at. My biggest question mark is whether or not gold is ready to go here in the first quarter of the year. Once we're in an easing cycle on the back end of the year going into 2025, it's very easy to build the gold thesis. But really trying to figure out when is the actual starting point of a legitimate breakout that gets us beating all of the highs we put in over the last several months is really the key thing to try to sort out. To me, I still think that the first quarter can be a lot more volatile and a lot more likely to have fake outs. And so I'm not trusting any initial breakout. On page 9, you can see we're still trading above the 50-day moving average. And it does still generally look bullish, but I'm a little bit more short-term neutral and think that we could have a fake out and even a temporary trip below 2,000 that would only end up being a buy on dip opportunity. In the end, I wanted to just touch on 2 more charts here. Now, Eric, what are your thoughts here on uranium?
I continued to buy the dips on uranium mining shares this week, and I think the bull market in uranium has only just begun. Of course, nothing ever goes in a straight line, and we've already had a great run here, but I am still max bullish on this market.
Yeah, to me, this has been a buy on dip. Because when a market has this kind of momentum, rarely does a V-top. The big question for me is this next leg higher able to beat the previous highs and maintain this kind of momentum? Because if we see divergent momentum and a failure to break to higher highs, that to me would suggest that some sort of a swing high may be coming in and some multi-month correction may start. For now, I'm buying the dip in anticipation that the bulls will prevail, but it'll be really important for them to prove what is next. The last thing I want to touch on is this chart on the 10-year Treasury note on page 11. And in the post-FOMC and Powell's press conference, bonds broke out as yields broke down. And it really does look like this is a bullish continuation pattern. Staying above its 50-day was a classic flagging formation, zigzag pattern. And you have a scenario where if this breaks out, we might be heading back to the levels where we traded in the second quarter of last year, which is levels up around the 116 level on the note. So it'll be interesting to see whether this breakout sticks, but I certainly think that on the short term, bullish bonds looks like it's working.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.